Attention, everyone. Whole life dividends are about to be announced shortly. Are the dividends going to go up? Are they going to go down? How do they come up with the dividends? Let's break it all down. We're going to talk about top frequently most asked questions with regard to dividends on participating whole life insurance. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me, as always, Christina Wyatt at Control and Compound. How are you, Christina?
Hey, Darren, I am doing great. How are you doing today?
I'm doing great. We're going to break down the whole life dividends, everything you need to know about them. Before we jump in, can you please let our listeners know how they can follow us?
Yeah, of course. So if you are listening on your favorite podcast platform, you're going to want to subscribe and then leave us that 5-star review. If you're listening on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on our social media accounts, TikTok and Instagram at Control and Compound.
Alrighty, so it's coming up to that time of year, Christina, and we're gonna get into the different insurance companies we deal with and their dividends, how they're calculated, what we think they're going to be, etc. But let's just start with some of the simple questions that we compiled from listeners. Christina, I'll ask you the first one. Why does the dividend matter to policyholders?
This is a great question. Why does it matter? So the dividend forms part of our cash values, right? So in an infinite banking policy, we're all about the cash values. That's what we're trying to grow here. And the dividend makes up a component of that. So in your cash values, you have your guaranteed cash values, you have your additional deposit option, and then once per year, a dividend is declared and paid to that policy. And that dividend contributes to the growth in your policy. We're going to use the dividend to purchase death benefit, grow our cash values, which in return will grow the cash values and grow the death benefit. So the dividend is important. It's not everything that makes up your cash values, but it is very important to the growth of your infinite banking policy.
Perfect. Thank you. What's next?
So the next one is, I had mentioned that we take a paid up addition with our dividend. Is that the only option that we have for our dividends?
No. So there are other options. Depending upon the company, there's a couple other options. But for 99.99999% of listeners, it's going to be paid up additions every single time if you're looking to grow your cash value. Some of the other options some of the companies have are cash, where you can actually get a cash payment. Well, that's just going to stunt your long-term growth. We don't want to do that. There's a premium offset, where a premium reduction, where they'll reduce your premium by the dividend. You save a few pennies. But again, what you're effectively doing in those dividend options is you're interrupting the compounding, and we don't want to interrupt that tax-free compounding. So every single time we're going to choose paid up additions. If there's a reason to choose another dividend, I haven't seen it yet for what we do. Okay, so if you're looking to grow cash value, you're going to select paid up additions as your dividend option, full stop.
Absolutely. We need that uninterrupted compounding.
So the dividends are exciting, Christina, but do the insurance companies always pay a dividend?
Okay, so the dividends are not guaranteed. That is not a guaranteed portion of your cash values. There is a guaranteed portion, and your additional deposit option is guaranteed because that's your cash, but the dividend is not guaranteed. Although the 4 companies that we work with have been paying dividends for 150 plus years, right? So like they paid dividends through the Great Depression, they paid dividends through the 2008 market collapse, and then the pandemic and COVID. So these companies have never not paid. Since having these policies of these par funds have never not paid a dividend. So are we pretty confident that they're going to pay a dividend? Absolutely. Contractually, are they guaranteed? No, they are not. Now, I did pull a stat from 2021. We don't have our 2022 reports yet, but in 2021, the 4 companies that we used paid $2 billion in dividends out to their policyholders. So do they have to pay? No. Do they pay? Yes, they 100% have. They paid this year. It's locked in for next year, and they've been paying 150 years back. So, yeah, they typically do pay. Is the answer to that question.
That's simply incredible. You think all that's happened in the last 100 plus years, 150 years? I think we've been through like 25, 30 recessions since then, market corrections, and every single year, just in and out a dividend every single year. Just unbelievable track record. Now, Christina, when do they announce the dividends for the companies that we deal with? So for our listeners that have one of the big four companies that we deal with, when do they announce those dividends?
So one thing to remember is the dividends only announced once a year. So once it's done, it's done. This is only a one-time deal. We're locked in. It's all good. Our four companies that we work with typically start announcing in March and finish up in June. And then the dividend takes effect a few months afterwards, right? And they're all kind of in that time period of when they start. And then that dividend is locked in for that following year. So when we're hearing the announcements now for this year's dividend, it's the 2023 to 2024 dividend that's being announced. So when we're looking at illustrations and stuff, we get 2 years locked in. Like we know what they're going to be at this point when you're looking at those dividends, and once it's paid, that becomes a guaranteed too, right? But sorry, off topic with the question. They do it once a year. It's usually between March and June is when we get those announcements, and we do update our clients immediately, and we always announce any dividend updates in our podcast, in those update podcasts that you hear once a month. So over the next couple months, make sure you listen to our updates, because that's when we're going to be sharing those dividend announcements.
Perfect. Okay, what's next?
So the next one, and this is a good one, is a par policy holder different than a shareholder? So when we're receiving these dividends, how are they getting them? Like a shareholder, or are they getting them like a policy holder?
Yeah, well, it's totally different, and it's I think it's better to be a policyholder. You're gonna be guaranteed you can't lose money. Once you get a dividend, it's yours to keep. But if we just kind of look at a two types of insurance companies. So we're going to have the participating whole life that we deal with three of our four companies, and that way they operate, they are have shareholders for all their lines of business. Okay, that's separated from the whole life. So the term insurance, the group insurance, the investments, all the profit from those lines of business are going to go to the shareholders. But on the participating life side, where there's billions of dollars over there in the participating whole life fund, that is separate and segregated, and all the profits or all the dividends are going to go back to the policyholders there, with a small percentage going to the insurance companies to manage it. But basically, all the profit from that whole life side, participating whole life side, all the investments, all the returns, premiums, all the other things we're going to talk about, how they make money, that's going to benefit the policyholders. So we benefit as policyholders. On the mutual side, we have one mutual company we deal with, and instead of being separated by lines of business, the whole life policyholders own the entire company or benefit from the profits of the entire company. So from the group insurance, term insurance, corporate or RSP investment, stuff like that, all the profits of the company go to the whole life participating policyholders. And those dividends are worked out about the same as our participating whole life, just we got some companies that are bigger, some are smaller. All good companies, all the four companies we deal with, all major Canadian insurers, all great companies, and every single one of them have paid a dividend each and every year since inception. So incredible track record. But yeah, much different than a shareholder. Just from the benefit of the policyholders on the par side, the entire company's profits on the mutual company side.
Well, yeah, and you can't take a shareholder as a paid up addition. Like you can't put it in your policy to grow that cash value. So there's lots of different reasons, but yes, absolutely.
I'm not going to pay taxes on a dividend from my participating whole life contract, as opposed to if I get a dividend from the Royal Bank, it's taxable. So yeah, there's all kinds of advantages: tax-free environment, consistency, track record. There's really no comparison. These have been around as long as Canada, and they've been paid a dividend every single year.
Yeah, so much different. So I think we should get into the big, a really big question this time of the year is what's going on up there? What's going on with the insurance companies? How are they deciding what these dividends are? A lot of people think that it's just one factor, investment returns, which we'll chat about, but that is not the only factor with these, right? There's a couple different ways.
Yeah, so let's break down some of those different ways. So we call it the 4 ways to win, but it's again, Christina mentioned it. People think it's just the investments, but there's some other factors that really drive the profitability of the fund. So, Christina, what's a couple big characteristics of the profit that people don't realize?
So a big one is mortality. So the longer people are living, because out of this participating fund, the death claims are paid, right? And if people live longer, well, those funds are going to stay invested in that participating fund longer, which is obviously going to be good for the policyholders. Over these, 100 plus years, mortality has gone up. Canadians are living a lot longer. So this is impacting our participating fund positively, right? We're seeing more funds invested. We're not having as many death claims paid. And that is going to contribute positively to when they announce the dividend. Now, if it was opposite, we had more death claims, which it hasn't been. And actually, we were looking at some COVID stats and whatnot over the last little bit on if that's going to impact the dividend. And it didn't actually. It's not, they weren't as large numbers as what we thought they might have been contributing to death claims. But anyways, point is, they're going to look at those things. They're going to look at their death claims, and that's going to help them decide what the dividend is. So that's one factor they're going to throw in there. And obviously, as Canadians live longer, that is going to impact our dividend positively, which is nice.
Yeah, and if just one note on that mortality, Christina, like the insurance companies in Canada, they don't promise to pay a death claim. They physically have reserves set aside to pay these future claims. So if you think of it, if the insurance company looks at it and says, well, we thought this 40-year-old was going to die at 75, but now it's 78. Well, we don't need to pay a death claim and we can have that money invested longer. So for most insurance companies, the insurance companies go, great, we can release some of that reserve back to our bottom line, right into our profit and pay it out to the shareholders. But for the participating whole life policy holders, well, we own the fund. So when they have extra mortality, they can release some of that reserve or increased mortality. People live longer. They can release some of that reserve to the policyholders in the form of dividends. So it goes right back to the policyholder.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
The next one we have is cancellations. So unfortunately, there are a lot of advisors out there that do not know how to set up these policies properly. So you can set these up all wrong. We've talked about that a lot in the past as well. And when you set them up wrong, your cash values are not great. Sometimes they're non-existent in the first couple years. And what happens is people, might realize this is not what I signed up for, and they cancel their policies. There's not much cash to take back in those first couple years because they weren't structured properly. Well, that's going to be a win for the people that are structured right, because we're going to receive those funds back and they're going to stay in the policy, into the participating fund for us. And they're going to put that into their calculations. When they're looking and doing their calculations for the dividend, they're going to see if there's any surplus there from individuals that have canceled their policies early on, giving a windfall to the policy holders.
Yeah, I was trying to analyze, and I can't quite get the numbers down on the cancellations through COVID, because a lot of people didn't have money during COVID or had reduced money. Now, a lot of people are flush with cash, but I'm curious to see how many policies lapsed during COVID that actually increased the profitability of the fund for the dividend for us policyholders that didn't lapse. And again, when we say lapse and not get a lot of cash back, just to emphasize what Christina said, it's if it's poorly designed. And there's a lot of insurance policies that are not designed for cash, not the policies and the infinite banking policies we're talking about.
One point to that though, Darren, is I do all the reporting around here, and I can confirm that at Control and Compound we had 0. So at our office there were 0 because they were all set up properly to be able to handle something like that, right? So I can 100% guarantee and confirm to you that we didn't have any of that happen here. I don't know what happened elsewhere. It probably impacted the dividend elsewhere, but here they were all set up correctly.
Yeah, and we didn't have any Control and Compound clients who lapsed their policy, but we certainly had some that were impacted by COVID and financial and took a year or two off paying their premiums. But because they were structured properly, they had that flexibility to do that, and they weren't forced to lapse like a poorly designed contract. So, dealing with someone who knows what they're doing is key. What do we got next after cancellations?
All right. So the expenses. So
Yeah.
expenses.
Yeah, so just like reserves for death claims, insurance companies set up reserves. They manage risk for a living. A bunch of actuaries walking around trying to be safe and prudent. What do we do? Well, they set up reserves for expenses too. Expenses and taxes, not a lot of taxes, just some minor stuff. But the expenses, they set up a reserve for expenses. Well, expenses have really shrunk through the years, and the reason expenses have shrunk is just technology, right? Back in the 80s, you could walk through a head office of an insurance company. There'd be all kinds of actuaries with pocket protectors, calculators, walking around doing stuff. There was charts and graphs. They used to have rate books. Oh, if you're 40 years old and you want to buy this much insurance, this is how much it is per thousand. The agent would figure it all out. Same with the dividends calculation. They would all these teams of actuaries calculating stuff. Well, now they can do it on an app on a phone. Well, maybe not that easy, but with technology, with computer technology, with all these different pieces of technology in the last 20, 30, 40 years, the expenses have shrunk for these insurance companies to manage these plans. Well, that's a windfall typically for any insurance company if they're benefiting from the profit of the reduced expenses of the company. But in this particular case, because it's the participating whole life fund and we own it, when those expense reserves are larger than we want, we can release some of those expense reserves back in the form of dividends. So again, helps bump up that dividend when we're able to manage expenses. And that's not going to be a huge swing every year, but through the years that's been quite significant. And only the participating policyholders or a mutual fund company would benefit from that. The other 99.9% of policies, any improvement in expenses benefits the insurance company, not the policyholder.
Yeah, absolutely. And the last ones, we've gone through three. So this one it is a key role, obviously, in the participating fund, because what happens is we pay our premiums as policyholders. They get invested inside of that fund, and the death claims get paid out, and then they release the dividends. So the investments are definitely a key role when we're talking billion-dollar fund, over $1 billion funds here. So the investments are going to impact that dividend as well. Darren, let's just discuss the investments a little bit more in detail.
Yeah, well, again, obviously they're nice, strong, stable investments. If 150 years they paid a dividend each and every year, never missed a year. But what we like looking at is, well, we think investing in real estate is a wonderful spot to invest a portion of your money. And if we look at millionaires and billionaires, 90% of millionaires and billionaires did it through real estate in the last couple hundred years in Canada. Well, it's no surprise to us that this fund invests a lot like a real estate investor, right? They're investing in bonds and in mortgages. And when we talk about mortgages, a lot of commercial mortgages there, some of the higher interest rate ones. They invest, 15, 20%, depending upon the company, in the stock market. But it's not just the stock market. A lot of it is private equity, which is a specialized, more, I would say, lower risk, higher return if done properly. Private equity, where they would buy, a private equity firm would buy a bunch of mature companies, profitable, package them as one company, and then sell them as one large company, and everybody makes money. Well, again, when you're talking billions of dollars in these funds, they're able to participate in some of these things at a low risk, higher return environment, and deals that we wouldn't be able to see as individuals. Same on the mortgages, the bonds they're able to purchase. They're just able to do things on a scale at a level that we can't, because A, they've got 100+ year track record, and B, they have billions of dollars to invest. So they get a better ability to invest in stuff that we couldn't invest in.
Yeah, one note on the mortgages that I think is key to note, and you say commercial, and sometimes people shy away at commercial right now with, people leaving office buildings. These companies all need office buildings. So they are typically, if you look in your city that you are right now, there's a very good chance that you are going to see the name of one of our big four companies on the side of one of those large buildings where they are employing their staff. So, if they need the building, it's I don't think they have to be too concerned with the commercial aspect there, as they are their own tenant in many of these situations too, which is kind of cool, right? When you're looking at the mortgage side of things.
Yeah, there's some of the biggest real estate owners in the country are Canadian life insurance companies. So again, safe, consistent, paid a dividend each and every year for 150+ years. not just the investment returns, but there's other ways we can earn money on this. Anything else, Christina, before we wrap up?
Yeah, a couple little things on the investment returns that I want to mention is the smoothing, right? So just because they make a large return in 1 year, if you look back at historical dividend rates, they are very smooth over a very long period of time. We don't have that volatility. We hate volatility, and the volatility is very low with these dividends. That's because they smooth the investment rate. So just because they have a great year, they're not going to release all those dividends. They are going to hold on to some, and those returns, sorry, not the dividends, they're going to hold on to some of those returns for those later years, for those bad years, right? So they always smooth out those investment returns, which is really great. And it's not correlated directly to the stock market, right? I think that's another very important thing to note. This year, last year we seen negative 20s in the stock market, and our dividends went up, if not stayed level. We're still seeing them go up this year. 2008, a lot of them were paying 7 to 8% in dividends, so not correlated to the stock market. And then another huge one is that dividends are vested. They're done, right? Like you said something a little bit earlier that I wanted you to add on that side of things, but like the dividends are vested is huge. You can't lose these, right? This is not like the stock market where you can take a negative 20 dip. Once a dividend's been paid, it cannot be taken back, which is, that's a pretty huge guarantee.
Like I can't emphasize that point, Christina, enough that you made. Like if you have 100 grand in the stock market, next year you could have 50 grand or 60 grand or 70 grand. If you have 100 grand in cash value life insurance, you cannot be below 100 grand next year. In fact, you're guaranteed to go up. Plus the dividend's always been declared. So, from a safety position, it's night and day. And just one more note on that dividend, Christina, because we are seeing the dividends come up right now. So let's just talk about that. So we were in an extremely low interest rate environment for the last 15 years. Even with that extremely low interest rate environment, okay, remember what the whole life fund invests in. A lot of the stuff like bonds and mortgages are going to be interest rate sensitive. So even in that low interest rate environment, we've been able to maintain a dividend for most of the companies at 6% or above, which is incredible when interest rates were basically zero for that long. And the reason for that, it wasn't just the investment returns. It was A, they had different investment returns than us, but B, we had those mortality and cancellations and expense gains. So the other ways we had the smoothing. But now we're seeing interest rates go up. So when interest rates, again, they're not guaranteed. We're not promising what the future dividends will be. But historically speaking, we'll go back 150 years. When interest rates go up, the dividend rate for whole life policies go up, but there's a lag. And the reason why there's a lag is if they invested in a 5-year mortgage at 3%, well, if that was 3 years ago at 3%, they can't cash that in until it comes due at year 5, and then it's going to renew at 6, 7, 8% or whatever the rates are at the time. So as those mortgages renew and the bonds renew at the higher rate, we're going to see the dividend rate go up. And we saw it last year. 3 of the 4 of them went up. This year, one company's declared it's already up 1/4 point. The other 3 will declare in the next couple months. And the expectation is dividends will go up and will, not necessarily go back to the 6%, but will continue to rise, not guaranteed. But we're trending in the right direction. Like if you wanted to buy, if you look at the whole life dividends, it is about to turn, and I think it's about to turn up fairly nicely in the next few years. So it's really the perfect time to get in.
Yeah. Keep in mind, it moves like a turtle, though, once per year. It moves like a turtle. It's not going to swing, but you know what? I love that. I hate swings, so that's cool with me. I'll move like a turtle upwards all day long. It's all good.
We are whole life geeks, and we admit that. But I got to tell you, it's pandemonium in the office when they announce dividends. Like, oh my God, so and so announced a dividend! Yay, it's up! We're celebrating, ringing bells. It's fantastic, but it's we still get excited, even though we know it happens every year, and it's always happened every year. But especially now, we're going to see some dividend increases, hopefully this year. All good news. But yeah, an increase of a dividend of 25% is not going to make you rich, or 25 basis points is not going to make you rich. If the dividend goes from 6.1 to 6.5, great, that's good news, but it doesn't mean you can go buy a Porsche tomorrow. Long term, you're going to be wealthier. Okay, so that's whole life dividend. We get everything covered, Christina?
I think, high level for sure, given, if you've got more questions or there's things, we're always open to feedback on these podcasts too, right? So we want to hear from you if there's something else that you want us to dig into a little bit more. Like we said, we are whole life geeks, so we could totally talk about this for another 45 minutes, but we're not going to do that to you. But if there's something specific you want to chat or you want us to chat about, just let us know. We're happy to have that conversation.
Yep, I love it. So the takeaways on participating whole life insurance: paid a dividend every year going back 150 years or more, depending upon the company, never missed a year. There's all kinds of different ways they make money, not just on investment returns, but all the other different ways. It's going to grow tax-free. Once you get a dividend, it's guaranteed. They can't take it back. And like we say, we got guaranteed returns plus the dividend, and all the 4 companies we deal with have paid a dividend each and every year since inception of the Whole Life Fund. That's it. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.